Hello and welcome to our short briefing on the Seven Investment Management Personal Injury Fund. And I'm joined today by my colleague Alex Scott, Senior Investment Manager in the team. Morning, Alex.
Good morning.
So, Alex, let's go back to the beginning. Why did we actually start this in the first place?
Well, we worked together with Nestle Partnership, one of the leading IFAs in the personal injury sector, to develop a fund for the particular need of that group of people. So those investors need a fund that can generate real returns over the medium and long term, but with very low volatility, low risk of big drawdowns in the fund.
And I presume things must have got considerably worse as interest rates dropped right the way down and people desperately trying to find returns.
I think that's right. As interest rates have come down, as the yields on gilts and inflation-linked gilts in particular have come down, it's been very hard for investors to get those low-risk returns that have got any meaningful appeal at all.
And what I've seen certain circumstances as well where people ended up, in order to try and get greater returns, taking much, much greater risk.
I think that's one of the key reasons behind this, is that we did see investors taking far too much volatility in their portfolios and, of course, exposing themselves to big losses on what should have been very low-risk portfolios.
For quite often an item which they've only just got one payment for, and that's it.
Absolutely.
Presumably these same disciplines apply to other areas, such as trusts and charities as well?
Well, I think there's potentially quite a broad use for this sort of fund. Those qualities of good, long-term, real returns, but with a very tight eye on risk and trying to limit those drawdowns, limit those shocks for investors, I think it's got quite a broad application.
And presumably quite a lot of governance, both legislative but also in terms of cases as well around this as well.
Well, there's certainly the specific governance around personal injury claims and the expectations that awards made are going to have to last those investors for life in potentially very difficult circumstances.
So when did this first start?
So the fund launched 3 years ago. We're seeing good growth in the fund over that time.
In fact, it's just gone over 100 million now.
We're closer to 120 million now. The fund's grown very well during that time. And I think really it's been doing what was asked of it. It's generated those solid, low-risk returns with keeping very tight eye on volatility.
Now, you've gone about the construction of this portfolio in a really rather different way from what I've seen with other defensive portfolios. How have you done this?
Well, we start, as we do with all of our portfolios, with spending a lot of time on getting a strategic asset allocation right for our fund. And that means looking at the returns and risks and correlations of all the different asset classes, trying to construct a mix that will do the job over the long term. But on this fund in particular, we're spending a lot more time and a lot more attention on controlling the downside, on looking at the implications of that asset allocation for the downside risk and doing what we can to keep that to a minimum.
I mean, other people have been trying to launch cautious portfolios. What do you think stands this one apart from what else you see in the market?
I think the focus on risk is very important. There is a high level of fixed interest allocations, bonds in the portfolio, and you'd expect that in a cautious portfolio. But I think the degree of diversification within the bond allocations that we're using and the way we combine that with small, sensible allocations to some other asset classes, to quite a wide range of other asset classes, really is quite different.
Yes, it looks as though you've applied that same sort of style as you've done with the other risk profiles. So there's still equities in there, the alternative asset classes. You wouldn't normally expect to see this in this style of portfolio.
Well, I think what's important about it is the correlations of those asset classes to bonds, the mix that they bring in terms of having enough there to make a difference for the long term and help to generate the growth, the real returns above inflation that this sort of portfolio could be looking for, whilst keeping the scale small enough that the volatility in those asset classes isn't overwhelming the portfolio.
So, Alex, it's now reached quite a sizable level now. So how does that impact on actually how you manage this fund?
Well, actually, the size of the fund now has opened doors. It's given us more flexibility.
How's that?
Well, it's helped us find ways to drive down costs in particular. And one of the things we've been able to do is to replace some of the fund or ETF holdings with baskets of bonds in particular. So we can take out some of the cost of accessing those investments by holding the bonds directly, holding a basket of bonds that should deliver the returns of the asset.
So these are individual holdings then? So instead of necessarily actually having a fund or just an ETF passive or anything like that,
Absolutely.
You can bypass all of that?
So we can bypass that, we can take out those costs
Yep.
And hold the basket of gilts or inflation-linked gilts or overseas government bonds rather than being confined to using ETFs.
So this is quite innovative then. I haven't seen this coming through before. So how do you think this is going to now stand up in our new normal world of lower, slower growth?
Well, I think there are several aspects of that are important, and one of the keys is that we face this world. We need to take the easy wins where we can, and one of the easiest wins is driving down cost in the portfolios and being very conscious of spending on management fees where it's worth it, and bypassing that and delivering the asset class returns as efficiently and cheaply as we can where it really isn't. So we have that as a high priority. But I think elsewhere in the fund, we need to be conscious that yields are low. We face this hunt for yield. Let's be creative. Let's be sensible about how we do that.
But it's in the new cautious sector, and there are one or two other funds in there, but I can't see anyone really of this sort of design.
I think there are very few other funds, even within that new 0 to 35 equity sector, that are quite as cautious and low risk as this. Yes, there is some risk in the fund. It does have moderate volatility, very low volatility, but I think against that peer group, it is very much towards the lower end of the risk spectrum.
Okay, bottom line, how has it actually performed over those 3 years?
Well, I think it's done what was expected of it, and returns over the first 3 years have been, on average, around 5% a year, with very, very low volatility, and I think that's what our investors wanted to see.
Okay, Alex, thank you very much. I think this is really important because there's a duty of care for looking after everybody's money. When it comes to personal injury, I believe there's a higher duty of care, and I'm horrified when I see some examples of the risks that people have been given for quite often payments, which is going to be a one-off payment to cover some appalling circumstances they've been landed with. Alex, thank you very much indeed for your time. Hope you found that helpful, and if you need any more information, do contact us directly or through your local 7am contact point. Thank you. Bye-bye. And if you'd like any further information, we'd be delighted to talk to you, so do give us a call. Thank you.